and welcome to financialexpress.com. I'm Shaleen Agrawal. We have with us today Nikhil Kamath, founder of TrueBeacon and co-founder of Zerodha. Welcome, Nikhil, and thank you for being with us.
Thank you, Shaleen. Thank you for having me.
Nikhil, could you please tell us a little bit about the beginnings of TrueBeacon?
Yeah, so a couple of years ago, this started from something I needed. In fact, I was looking for places to, invest some of my prop capital. And every fund I went to, the one thing I realized is everybody charges too much in this ecosystem. At least back then they did. I went to like wealth managers who would tell me, we will charge you 2% to introduce you to a fund manager. Then who will then again charge you 2% if he makes money or doesn't make money for you. So if you lose 4-5% of your money even before you've gotten started, you need some kind of an oracle to be able to beat the market in the long run at those costs. So we wanted to start a very simple product. I think the very basic premise we had was to create something which is cheaper, more efficient, simpler to understand. So we removed every other norm in the industry like distributors. We said we don't want distributors. We'll wait for the client to come to us. People have lock-in periods. We said we won't have lock-in periods. We'll keep it totally open-ended. So people can enter at any time, exit at any time. In terms of transparency, we said people report NAVs monthly, we report NAVs daily, we'll give you a dashboard where you can check what is going on. And instead of charging a fee on TrueBeacon 1, the fund, where if you make money or do not, normally you would pay, we said we will only charge a 10% flat carry, and that too with a high watermark level. So you don't pay on your profits twice. So we put these things together. We started the fund. We had no plan of how we will scale, who we will cater to, but this was very much the product I thought I would like to invest in if I were to be an investor. And it's been a couple of years now. We've started a bunch of products. Today we have a PMS, which we launched just now. We have a fund which is focused on foreigners investing in India through Gift City. And we have the flagship fund, which is TrueBeacon 1 as well. And lots of learnings. If I have to summarize the journey, I would say the one thing we have done, which very much resonates with our ethos, is we've been very conservative from the beginning, and we continue to be conservative. Even today, where the markets are, I feel like there are too many headwinds and macroeconomic issues, which maybe do not warrant the multiple that the markets are getting today, but the markets have a mind of their own and many might disagree. So we continue to remain conservative. We've been hedged between 40 to 60% throughout our journey. And as we speak, we continue to remain hedged 50%. Yeah.
We'll talk about those hedges in details. Before that, you spoke about the high fees of such services, which makes it, in your words, which needs an oracle to beat the markets. But then those services do exist, and those have been there for quite long and growing, and getting clients as well. So what is it that they cannot see?
Well, I don't think it's a structural issue whether they will continue to exist or not. I mean, a lot of them are my friends and I hope they do well. But the need for a cheaper, more efficient service out there, I think, was required. And we've kind of like, because we are charging so little, I think we only work on scale. So we've had to focus on the very top end of ultra HNIs. Because, if I service a client and he only puts in 1 crore rupees, at the fee that we charge him or the carry that we charge him, it might not make sense. But I think there is room for both. If you look at stock market penetration in India, it's abysmally low. Very few people have access either directly or indirectly today. As that number kind of grows, I think more products, more room for people, wealth managers, asset managers will be there in the Indian ecosystem.
Sure. You also talked about lock-ins and those kind of restrictive practices not there not being there in your fund. But then eventually those are the things that help a, a wealth manager or a portfolio service provider to have some visibility over the fund or over the cash flows. How do you beat that?
So we kind of stick to large cap blue chip stocks only, and these typically are very liquid. Like what I might not be able to get rid of or sell in the mid cap or small cap space, that problem doesn't really arise with large cap companies. And at the end of the day, the reason why people come to the public market vis-a-vis private or debt is the liquidity that it has to offer. I think we don't sell it enough. People don't realize it enough. But the ability to get your money back on any given day without having to pay a fee at the last NAV of the day, I think is an incredible benefit, which kind of differentiates one fund from another. It to a certain extent, it also becomes like, tomorrow you can question whether you should leave the money in your bank in a savings account versus here, if you're truly able to achieve open-ended.
Sure. And what's the ticket size for investment in True Beacon One?
Typically, people come in at the $1 million, $2 million level.
And what would you the fees on that?
There's no management fee. There's none of those setup fee, exit load, all of the other stuff. We only charge a carry of 10%. So if you come in at 100 NAV and you exit at a 110 NAV, you pay 1 as fee.
You also mentioned about a watermark level.
Yeah, high watermark level. So if end of year 100 has become 110 and you have paid 1 as fee, if the NAV goes down to 105 and comes back up to 110, you don't pay again for the same gain. So we do it with a high watermark.
Sure. Yeah, what's the investment philosophy of True Beacon? It being a Nifty focused fund, how does it invest in markets?
Yeah, like we were talking earlier, we're very conservative. So in the 50 companies in the Nifty, we build a portfolio of 20-25 companies. But the key determinant for us almost is that hedging ratio. Today we are hedged 50%. So the markets go up 10, we are only up 5. But we run some strategies on top of that, which we hope will give us, say, a 40 or a 50 bips alpha every month, which for the year we hope will make up about 5%. So ideal scenario, if the markets go up 10% this year, we want to be up 6.5, 7%.
Would you be willing to share those strategies that give you alpha, and then also the hedges?
The hedge is quite simple because if we have like 100 to allocate, we would put in 50-60 in equity, and the balance we would invest into, say, government securities, tax-free bonds, essentially as close to risk-free debt as possible in India. We don't take much risk on corporate debt or anything like that. So we hedge through that. These strategies which aim to give us a little bit of alpha are, like they're focused on options and taking advantage of mispricing in options, and think of it as something which takes advantage of short-term discrepancies in the derivative market.
And are there a lot of short-term discrepancies in derivatives?
I think there are still, because if I don't think the Indian markets are as saturated as the Western ones, and by virtue of that, I think they often are. At the end of the day, prices still move based on emotion, and the maths kind of follows, right? So there are many times when you will have those opportunities.
I and our audience will be quite interested to know how to identify those discrepancies.
Well, I think very simply, use an option pricing model, figure out what the theoretic price of the option should be versus what the market price is, and you can do an arb between the theoretical price and the actual price. Or you can look at what the implied volatility of a certain thing is versus the historical volatility, and you make a prediction that it will regress to the mean if the deviation between the two is very high. So stuff like that. Not that these are short ways of earning alpha, but I think the odds are sometimes in your favor, and you kind of act upon it when they are.
Of course, one has to be an experienced trader to do all that, which you are, but not many people maybe. So I just wanted to add a disclaimer there. You know, about this new fund that you launched, factor-based fund. Would you want to talk about that a little bit?
So the factor-based fund is our foray into the PMS universe. So what we have done is we have put in a great team together, led by the CIO. His name is Rohit Perry, who has relocated from Singapore to join us. He's aided by this guy called Prashant, who's his deputy, and then we have Adarsh, and we have a very good team that has come together to launch this fund. I don't want to like comment too much on the specifics of that particular strategy because it is their thing, and I would love for them to speak about it someday and explain what they want to explain. But in the short time that it has been active, it just launched. I think it has been doing exceptionally well, and it looks very promising. If you were to look at, let me give you like the odds of it. The odds of that strategy beating the Nifty by 4-5% a year is something like 70-75%. So we're all very optimistic about it and looking forward to that.
4-5% over Nifty.
Yeah.
Okay. I did a little bit of a few conversations over factor investing with others as well, and over the long term, if all 5 or 6 different factors are put together, because then it barely beats the index. Has that been your experience?
Our biggest factor in the model that they're using is momentum. And I think the weightage they give momentum varies, but about I would say 30-40% of the weightage is biased towards momentum. And in the data that they've tested over the last decade plus, it seems to have worked quite well, the combination of factors that they're using.
So 40% weightage is for momentum. What about the other remaining?
So there are a bunch of different factors. There are 10 different ones, and I think there is a different allocation to each one of them. This I would love for Rohit to like maybe I'll connect you guys later and you can have a word with him. He would be best to explain this because this is essentially his strategy.
Definitely, we would love to have that interaction as well. Just sticking with momentum for a bit. Theoretically, does it happen that momentum can also work against the investor?
Yeah, I mean, in a choppy market, indicators around momentum will not work. Luckily, for the last, I don't know, many years, we've been in a broad bull run in India. So I think it's a combination of the two, right? Momentum does well when there is a trend, and mean regression does well when there isn't a trend. So how much weightage you give to either determines how well the strategy will do. But if we are sitting at some kind of a peak, if markets are overvalued, like our hypothesis or our guess seems to tell us that it is, then momentum will probably do well in the near future.
This brings me to the next part of our conversation. You mentioned it a couple of times in the last 5 minutes about markets being overvalued in your view. Could we talk about that? What makes you think so?
So Shaleen, I've been saying this for so many years that sometimes I feel like an idiot myself because I've probably like been trading full time, investing full time for 18 years now, 17, 18 years. And my view pretty much throughout that time has been markets are overvalued. So I think I fixate upon the negative a bit more than one should. But long term, it kind of plays out for me. It might reduce the quantum of my wins, but it really protects me when things get bad. Even though they haven't really in the last 17, 18 years, there have been intermediate drops and troughs in the market where having that kind of outlook helps. I think the market is overvalued because I feel the earnings of today do not warrant the multiples of today. And we live in a very globalized world. everything is so much more connected today than it was even like a few years ago. And I do not see why in the situation that every global market seems to have had some kind of a reckoning, seems to have corrected so much, why we are holding up in the manner that we are. We're so close to our highs, right? We're at 17,800, 900 today, which is barely like a few percentage away from our highs. I think Bank Nifty made a high last week as well. So I don't see the justification for that in the numbers that I look at when I look at economic indicators. I feel inflation is a problem in India, and if history is any kind of a teacher, inflation never really has a V curve. It doesn't go up to 10% and immediately fall to like 4%, right? Like I feel it will be a long drawn problem for which interest rates will have to remain high for a long period of time, a multi-year period, and growth is bound to slow down in that phase. There are some positives to weigh the other side to the negatives that I was speaking about. I mean, I could add to the negatives and say trade deficit is bad. We're importing a lot more than we're exporting. Unemployment is a big issue in the country. We have an election coming up, which means industry might be ignored for populist decisions, at least in the very like 6 months prior the election or a year prior the election. So outside of all of these, the positives, if one has to weigh, is I think the overall narrative around India in the world globally is very good. Uh, we've had great consistency of government on the top, and the Prime Minister has done an incredible job in selling the India story abroad. And that consistency has made us uh, very interesting to many global investors. So that adds some kind of a tailwind as well. But if you were to compare the tailwinds and the headwinds and look at where the multiples are today and how much other global markets have corrected, I remain a bit skeptical about valuations. That is my argument for why I think markets are expensive today. This will change again, if you ask me next week or the week after that.
I hope to catch you next week as well then. Uh, but then in your assessment, what is a fair valuation for, let's say, Nifty at this point?
I would say being maybe 20% lower than where we are right now.
You're effectively talking about a bear market.
I mean, we've gone up from 7.5, 8,000 to like 18,000 in no time, right? It's been a one-way rally. So I don't even think if we are in a 20% correction, like again, categorizing bear markets is difficult, like categorizing recessions is difficult. But a 20% downtick from here, in my mind, would not be a bear market.
Okay, I had not planned again to ask you such specific advice, but since you're talking about that, then at this point, would you advise investors to keep their positions small or book their profits in the longs and then maybe try to re-enter at lower level? Is that what you're telling investors?
Well, I feel people should diversify. A lot of the people who have come into the equity markets, especially retail guys who have come in the last 2-3 years, uh, they seem to have too much allocation to one kind of product alone, which is a vanilla long product. Debt has not really kicked off in India. With interest rates going up like they are, government securities, tax-free bonds, national highways, Indian railways, a lot of this debt has become reasonably attractive. And I think one has to split the investment corpus between debt, between equity, add some gold in the portfolio, which acts traditionally has acted as a great hedge against inflation. So that would be my recommendation to all. Like, take differentiated products which have exposure to different asset classes. Like even True Beacon, for example, by virtue of the hedging component, is very diversified. But don't keep levering up or don't keep like allocating 100% of your money to one single product, which is vanilla equity. Because then if the markets were to correct, and markets are cyclical, right, Charlene? Every decade, every 5 years, they will go down, they will go up, and that is the nature of the equity markets. So my advice would be get that diversification. Um, we should not. I think an investor does so much better when he doesn't look at the market from a 1 year or a 2 year perspective, aiming to make as much as they can, but more from a 10, 20, 30 year perspective. And the age group that most new retail investors are coming in at today, the 20-year-olds, I think they can afford to have that perspective. So plan in that way and not for the very short term future.
But that's where the conflict is. If we are taking a very long-term view of, let's say, equities,
Right.
20 or 15, 20 years, then doesn't it make sense to stay all in equities? Because over 15, 20-year period, any cycles you take, equities will outperform an equity debt portfolio.
Well, I mean, that's debatable, I think.
Sure.
See, ever since India has opened up in the 90s, we've pretty much seen one kind of a market in real estate, in equities. It's been bull all around, right? In that way, we're a relatively newer economy, or
Of
I
course.
would rather say we restarted in the 90s. But if you look at economies globally, you look at America in the 1920s, you look at what happened to world markets in the 1940s, preceding World War II, or again in the 1960s, there have been many times when there have been bear cycles which have lasted 10 years, 15 years for different developed markets across the world. If uh, if we take the base case as 11%, which is what the Nifty has done in the last 10 or 20 years, uh, I am not entirely certain that the next 20, 30 years will be 11%. I think we are more evolved as a market. We are significantly larger. And that 11% will probably slip down to 8%, 8.5%, or whatever. With debt sitting, recently I was looking at even SBI's fixed deposits and they were offering 7%. Uh, if the use case for you is risk-free 7%, equity market risk 8, 9%, uh, even though the other might perform in the long run, it still makes sense to have that stability in your portfolio because the ability to, kind of like sleep at night is also very relevant. Like you want a portfolio which is robust and gives you a certain amount of peace of mind as well.
And hence the 50, 60% hedge in your portfolio using debt.
Yeah, I think for me, I because of the position that I sit in as somebody who is part of an asset management business, I need to at some level be able to tide over short-term spikes in volatility which might occur. So tomorrow, if there is a 20% correction, I can't go back to my investors and we're down 20%. I think even for them to plan their savings and their investments, they like the fact that they have some kind of insurance here. So if the markets fall 20, we're only down 8% or 9%. For those reasons, I need to time the market a little bit, or attempt to, because nobody, I think, can truly do it in a way where one can, claim that they do it accurately. But for a retail investor, I think it's a different story. And for a savvy investor like a HNI or ultra HNI, I think this diversification that I was talking about adds immensely to their portfolio.
Hmm. Let's say the markets stay flat or might even correct a bit. But then what are the pockets where there can be some value or can be some outperformance for the short term?
So I've been, I think the one thing I'm betting on is the middle class growing in India. I feel that GDP per capita, that $2,000 a year, will definitely go up. And as that does, I've taken a big bet on multiplex companies, PVR, for example. I feel even now in India today, there aren't many avenues where a family of four can have entertainment at under 1,000 rupees for 3 hours and in a safe environment with air conditioning and all of that. So I think consumption story, especially focused on the middle class, I feel might do well.
Is that a long term view?
That's a long term view. I've full disclosure, like I've been sitting on this position for over a year. I think the one good thing PVR has done during the pandemic is manage debt very well. They managed to renegotiate with most landlords, and the management team is incredibly sound. And this is not like a recommendation for anyone to buy, but this is just like, just an example of a certain kind of company that I have been committed to for a while. And yeah, so everything like that, like companies like this, which take advantage of the middle class growing as a segment in India, I think will do quite well.
Okay, I was talking more in terms of cyclicals. Let's say someone who's not averse to a lot of churn in the portfolio. If they were to look at parking their money not in index or not in index heavyweight stocks, where can they look at for next 1 year to be safe or to grow returns while the index either stays flat or corrects?
And that's a very hard question, Shaleen. I wish I knew the answer, but very, very difficult to call. I think IT and pharma have taken a beating of late, whereas banking seems to have been doing well. I think uh, if we were to talk about cyclicals in the nature of the word cyclical itself, by virtue of one having done well and the other not having done too well, maybe it's good. It's a good time to be in IT and pharma. Yeah.
Sure. Um, do you have a view on large cap versus mid caps at this point for the next 1 to 3 years?
Which mid caps?
Large caps versus mid caps.
I like large caps generally. I always prefer them to mid caps because I feel the moat they have around the business is generally larger. And also, Charlene, when I invest in a large cap nifty company versus when I buy a mid cap company, I don't have to worry about compliance, governance, because so many people research these companies and track every little thing which is happening there. So for all of those reasons, I personally prefer large cap. I will have mid cap exposure in companies that I have a strong conviction of, something that is out of like the normal realm of things for me. But otherwise, I pretty much stick to large cap companies.
Hmm. You also said that things are way more global now than they were earlier, and there are so many global factors that are weighing down upon markets. Do you see there is a global recession looming?
Uh, I mean, it depends on whose definition. Again, recession is broad. If you
Sure,
look
let's
at,
call it a prolonged period of slow growth or a very painful growth.
yeah, so I think America defines recession as 2 consecutive quarters of -1% growth. By that benchmark, I think it's a certainty that America will experience that kind of recession. India, on the other hand, is working off a lower base. Let's say inflation were to like remain at 8% and growth goes down to say 3%. In my mind, that will feel like an inflation in India. I think unemployment will go up significantly. Things will be a lot more expensive. Uh, I think a lot of the wealth in India has kind of like found its way to real estate. I think a disproportionate quantum of our savings is sitting in real estate. So I think on the ground, we will really sense and be able to taste a recession when real estate corrects in India. And I'm a real estate bear, as I have been for a long, long time. But there is so much hubris attached to that industry in India. You talk to like most real estate developers, they will tell you blatantly that land prices can never fall. I can have many debates around that, starting from the demographic one with fertility rates dropping, the argument that more people but same amount of land does not hold true forever, or how higher interest rates will affect demand for home loans. And there's a bunch of stuff I can say, but uh, in summary, the hubris attached to how much they believe that land prices can never fall. I think the day land prices do correct, things will be crazy in India. I think uh, it won't fall 25-30% and stop. I think if it falls 30%, the next 10-20% will come very easily.
Okay, that's a pretty gloomy picture of the real estate investment. But coming back to equities, if let's say there is a recession in the US as we just defined it, and there is a very slow growth in India, what happens to people's equity or equity and debt or capital markets portfolios then?
Uh, so, I mean, there is data around this that when we start talking about a recession is when equities will get hit. But when we're in a recession, I think things are fine from an equity market standpoint. I would presume, I mean, I'm not such a bear that, I want this to happen, but I hope that India is able to avoid any kind of financial calamity and people continue to grow at a really good pace. And, we have like 8% GDP growth for the next decade and stuff like that. But if they were to, if things were to like get bad before they get better and we were to enter a recession, I would assume, we would have a 4-5 year period where there would be no gains made from the stock market while your money is getting eaten up by inflation at a rate of maybe 7, 8, 10%. So the thing with inflation, Shaleen, historically, people who have been able to beat inflation beyond a point, like you take Walker in America, for example, he took interest rates up all the way to 18%, but he had the ability and the gumption to be able to take that stance. And America saw many years of growth after Walker's time. But in the current setting, in the current world as we know it today, I don't think anybody is sitting on that. Uh, Nobody's that stable to take such a strong call on moving the rate cycle of any central bank across the world. So it'll be interesting to wait and watch. But I think if there were to be a recession, 4-5 years of no money being made in the stock market is totally possible.
And when do you see that happening?
I mean, I really don't have a timeline, but I feel like the possibility that it might happen is reasonable.
And then in that case, where do you see interest rate cycle now? Till what till when the interest rates will continue rising, and where will they stop?
Yeah, so if traditionally interest rates have had to go up above inflation before inflation starts coming down, let's say inflation, the government's number now is 8%. So I would assume interest rates will go above that. I think that's a long, long path. I don't think they'll go abruptly, but maybe they go 50 bips at a time, 25 bips in between, and over time they go to that point.
Yes, but then till 8% is still a long way to go, and we're quite far from that.
I know, but I think, see, when I look at things on the ground, when I look at floods and droughts and fires and energy crises across the world, the price of a lot of these commodities, which might be playing a big part in why inflation is where it is, including energy, especially with winter coming up, I don't think is going down in a hurry. I mean, this is another story, I don't want to digress that much, but the food security and scarcity problem, which one might experience as an aftermath of the floods and droughts we are witnessing today, I think inflation will remain elevated in summary for a reasonable amount of time. And when it does remain elevated, I think we have but no other choice to constantly keep raising rates, hoping that that dynamic changes.
Don't all these things scare your clients, investors in your fund?
Mm. So the idea is not to scare clients. The idea is to tell them that be cognizant to all that is happening in the world and get into a more hedged, diversified investment portfolio versus being 100% long equity. In the short term, you shouldn't sit and compare it with somebody who's levered and taking on a lot of risk and making 15% when the markets are up 10%, because that is bound to happen. But from a long-term perspective, I think this diversification will help people a lot.
Any final word? Any final word of advice for what should investors do over the next 1 year in this market?
To the investors who are 100% equity, especially the new guys who came in the last couple of years, I think this is very targeted advice, but diversify. Keep a lot of equity, but add some gold, add some debt into that portfolio.
One final word for the lot of new option traders that have come into the market in the last 2 years?
I think be reasonable. If you approach the market trying to make 50% a year, the odds that you're going to lose money is probably 80%. Be reasonable. If you put your money in a bank, you get 7% or 6%. Try to build strategies which give you 12%, 15%. The power of compounding is incredible. If you can make consistently small amounts of money, before you know it, compounding will take that portfolio elsewhere.
Nikhil Kamath, thank you so much for joining us. It was a pleasure talking to you.
Thank you, Shaleen.